International Accounting Standard number 38, which deals with the accounting treatment for intangible assets. Hello and how are you? My name is Leonard Tongai Mapenda, and I'm going to take you through this video session. And this video session is divided into two parts. The first part, we are going to concentrate on the accounting treatment for intangible assets, as per IAS 38. And the second part, we are going to look at accounting for inventories, as per the International Accounting Standard number 2. So, under part 1, we are going to focus on the key focus area that we'll be talking about. The first area that we are going to talk about, it is the objective of IAS 38. We are going to explain what does International Accounting Standard number 38 seek to achieve, as well as the scope, those areas whereby the accounting requirements for IAS 38 will be applicable. We are also going to look at what is an intangible asset, what qualifies or disqualifies an asset to be regarded as intangible asset. Then we are also going to look at the recognition criteria, at what point the entity is required to recognize intangible asset, as well as the measurement. And under measurement, we are also going to look at both initial as well as subsequent measurement. Then there's also the issue of related interpretations. And under this, we are going to look at IFRIC 2 as well as SIC 32. This one, it deals with the intangible assets that arises as a result of website. Lastly but not least, we are also going to look at the tax implications that arises as a result of intangible asset. So let us move on to the next slide, whereby we are going to look at the objective of IAS number 38. The objective of IAS number 38, it is to prescribe the accounting treatment for intangible assets that are not specifically dealt in any other standards. So it means that we have got other intangible assets that arises as a result of different standards. For example, we have got intangible assets that arises as a result of IAS 12 deferred tax assets. And in such instances or circumstances, the accounting treatment or the accounting requirements of that respective accounting standard that is given effect to the rise of the intangible asset in question are going to be applicable. We have got also intangible assets that arises as a result of employee benefits or as a result of the financial instruments as per IAS 32. So under all those circumstances, the accounting treatment of the respective accounting standards that is given effect or that is given rise to that intangible asset will be applicable. So the list of intangible assets that arises as a result of different accounting standards is not exhaustive. You can refer to paragraph 2 and 3 of IAS 38 for the full list of those standards. Then let us move on to the next slide, whereby we are going to define what is intangible asset. When it comes to intangible asset, IAS 38 defines intangible asset as an identifiable non-monetary asset without physical substance. So in as far as the definition it is concerned, there are three key words that we are supposed to drill down. The first word being identifiable. An asset is regarded as identifiable if it is capable of being separated or transferred, or if it can be rendered to any other party, either individually or together with other intangible assets, or it might arise as a result of the contractual obligation despite the fact that the asset is not separable. We have got also the issue that the asset must not be a monetary asset. Any asset is regarded as non-monetary if it is not money, or the entity does not expect to receive fixed amount of money from that asset. And the last aspect of the definition is the intangible asset must be without physical substance. In other words, you must not be in position to touch a fixed asset. We are talking, for example, we are looking at goodwill. You cannot touch goodwill or even trademark. So, you must be comfortable to drill down or to define all these three aspects which constitutes the definition of intangible asset. And in exams, sometimes a discussion type of question might come. So your duty as a student, it is to pay specific attention to detail and make sure that you apply the standard. You are going to be provided with sufficient information to necessitate or to enable you to deduce whether the asset is intangible asset or not. Now, let us move on to the next part of on the next part, whereby we are just going to look at different ways that the entity can acquire intangible assets. There are quite a number of them. An entity might acquire intangible asset through a purchase. Entity A might buy intangible asset from any other party or party B, or it might be as a result of business combination, whereby the acquirer is acquired the acquiree, and as part and parcel of the assets that has been transferred to the acquirer, the entity might also acquire intangible asset. Or they might be as a result of exchange of assets. For example, entity A might exchange its intangible asset with entity B, or it might be as a result of self-creation, that the entity might embark on a project whereby they can create an intangible asset. We have got example of Mark Zuckerberg during his college time when they developed Facebook. So that one is an example of a self-generated intangible asset. So those are the ways the entity can acquire intangible asset. Now, we are moving on to the recognition as well as the measurement of intangible asset. At what point is the entity required to recognize the assets, the intangible asset in its books? In as far as IAS 38 is concerned, the entity is only required to recognize intangible asset if, one, it has met the definition of intangible asset. That is, the asset should be an identifiable non-monetary asset without physical substance. And secondly, the intangible asset must meet the recognition criteria. And under the recognition criteria, we are saying it must be probable that the entity is going to generate economic benefits that are attributable to that intangible asset. And lastly, the cost of that intangible asset must be reliably estimated or reliably measured. Failure to meet all those, it means the cost that the entity has incurred are going to be expense in the profit and loss during the period that they have been incurred. Then we have got also the acquisition of intangible assets in a business combination. There is a rebuttable presumption that the probability recognition, it has been met. The reason being that when the entity has acquired intangible asset as part and parcel of the business combination, economic benefits are expected to flow to the entity. The only difference is the timing and the amount. The entity might not know the exact amount that is going to generate, or the exact point in time. But otherwise, there is that rebuttable presumption that the probability recognition is met whenever the intangible assets have been acquired as part and parcel of the business combination. Then we have got a situation of internally generated goodwill. Internally generated goodwill, it is not regarded as intangible asset as per International Accounting Standard number 38. The reason being, it fails to meet the definition of intangible asset, and it fails the identifiable part. Yes, it is a non-monetary asset, it is without physical substance, but it is not being capable to be separated from the entity. The entity cannot transfer it to other parties. Therefore, it fails the definition of intangible asset. Then let us move on to the next slide. Then we have got a situation whereby we are saying the recognition criteria has been not met. And if the recognition criteria has not been met, the cost that the entity has incurred to date is expensed. As simple as that. Then we have got also the reinstatement of the cost that has been previously recognized as an expense. Paragraph 71 of IAS 38 prohibits the entity to recognize or to capitalize the cost that has been expensed in the past to the cost of intangible assets. So it's some of all those areas that in the exam, as you are given the scenario, you must pay specific attention to detail to make sure that you've been in position to navigate or to answer, be it a discussion type of question or if it's a calculation, so you'll be guided with the requirements of the standard. Then moving on to the next slide, whereby we are now looking initial measurement. At what cost is the entity supposed to recognize the intangible assets in its books? So in as far as the paragraph 24 it is concerned, it says the intangible asset is initially recognized at cost. Then we have got a situation whereby we are saying we might have different amounts. For example, if intangible assets have been acquired in a business combination, the intangible assets might have their own carrying amounts, and they might also have their fair value. So which costs? And in as far as the intangible assets acquired in a business combination are concerned, the cost or the value that you are going to regard as cost, it is the fair value. Why? If you can go back to my introductory slide, we said IAS 38 is only applicable to intangible assets that are not specifically dealt in any other standard. And in as far as business combination it is concerned, business combination, it is dealt with under IFRS 3 as well as IFRS 10. So in as far as IFRS 10 it is concerned, the assets acquired as well as the liabilities assumed are measured at fair value. So what you need, the take-home point here is the intangible asset that arises as a result of business combination, the cost, they are measured at fair value. Then we have got a situation whereby we are saying the entities, they might decide to exchange intangible asset. In such instances, the cost is regarded as the fair value, unless if the transaction lacks the commercial substance. And when you are talking of commercial substance, we are saying the configurations of cash flows, that is the risk and rewards, does not change as a result of the transaction. Or in situations whereby we are saying neither the fair value of the asset given up or received are not cannot be reliably measured. And in such situation, the carrying amount of the asset given will be the cost. Then we have got the intangible assets that arises as a result of self-creation or self-development. And in as far as this type of intangible assets is concerned, they are divided into two. There are those costs that the entity incurs at the research stage, as well as those that they incur at the development stage. So, when it comes to the costs incurred at the research stage, these ones are expensed to the P&L. And we have got those costs which the entity incurs at development stage. These costs are capitalized to the cost of intangible asset, but only after the technical as well as the commercial substance feasibility have been satisfied, and the entity must intend to complete and bring into use or sell the asset, and it must also be in position to demonstrate that economic benefits are going to flow to the entity. Failure to meet this recognition criteria, the entity is prohibited to capitalize the costs to intangible assets. Then moving on to the next slide, we have got a subsequent expenditure on acquired in process and research and development project. We are saying we have got a situation whereby the entity has bought another entity in a business combination. So in such instance, if we have got a research which is still in process, under IAS 38, the acquirer is required to recognize that one as intangible asset. This is one of the exceptions that you as a student, you must be aware of and pay specific attention. So if entity A acquires entity B, and as part and parcel of the assets that entity A acquires from B, we have got a research project which is still in process. Entity A, the acquirer, must capitalize that onto the cost of intangible asset. That is one of the exceptions that you are supposed to pay specific attention to. Then on subsequent expenditure on that project is accounted for as expense or other research and development costs as per the requirements of this standard. So basically, that's one of the exceptions. And in tests and exams, please pay specific attention to detail to make sure that you've been in position to pick up all those issues. Then, after recognition now, we are now moving on to measurement. IAS 38 requires the entity to either choose between the cost or the revaluation model as its accounting policy. So we are going to look at both the cost as well as the revaluation model. But in as far as the revaluation model is concerned, we are not going to go through it because it is in as far as tests and exams are concerned. This one, it is now at level 1, which is the awareness level. So it's something that you as a student, you are expected to know, but not into greater detail. But however, we are going to look at the cost model. And under the cost model, what IAS 38 states is the entity is supposed to carry the intangible asset at cost, less accumulated amortization, as well as impairment losses. So in as far as impairment losses is concerned, I think by now you are aware that when we are studying or when we are doing FINAC, we do not study the standards or the subjects in silo. There's also the integration between various standards. Like in this case, we are in IAS 38, but it is also integrated with International Accounting Standard number 36, the one which talks of impairment. So the entity is expected to test, is required to test the intangible assets for impairment as per the requirements of IAS number 38, as well as amortizing that one. Then we have got also the issue of residual value. When it comes to the residual value, the residual value of intangible asset, it is regarded to be 0, unless 1, if there is a committed party which is going to buy the intangible asset at the end of its useful life, or if, as per the requirements of IFRS 13, there is an active market whereby the entity can easily refer to for the purpose of identifying the residual value, and the market must be in existence at the end of the useful life of the intangible asset. Failure to meet any of those requirements, the entity is supposed to record the residual value of intangible asset at 0. Then moving on to the next slide, whereby we are saying we have got, in as far as the intangible assets are concerned, the intangible assets might have a finite useful life, and under finite useful life, I think we have dealt with the residual value. Then moving on, we are saying the entity might also review the period of amortization. The entities, it is allowed to do so, but when it do so, it must do it as per the requirements of IAS number 38, which deals with the changes in estimates in accounting. So otherwise, that one is not a big issue. Then we have got also those assets with indefinite useful life. We are saying these assets, we don't know to what extent or at what point in time are we going to cease enjoying the benefits arising from this intangible asset. So IAS number 38 does not allow intangible asset with indefinite useful life to be amortized, but however they are supposed to be tested for impairment as per the requirements of IAS number 36. Then moving on to the next slide, I think this one is a repetition of the useful life of the intangible asset with indefinite life, useful life. Then we are now moving on to related interpretations. And under related interpretations, we have got IFRS 12, which deals with service concessions arrangement. This one, it is not examinable. Therefore, you are not supposed to stress yourself over it. But however, we have got SIC number 32, which deals with intangible assets that arises as a result of website. This one, it is examinable. Therefore, so the issue here was, does the intangible asset that arises as a result of developing a website, should they be accounted for under the requirements of IAS 38? So remember, as the entities are in business, they can decide to come up with a website for different reasons, either for external use, whereby the entity is going to market and promote its products or services, or for internal use, the entity might upload and store important information on the website. So there was need for clarity on whether should the requirements of IAS 38, should they be applicable, yes or no. Then the interpretation committee now, they reached a consensus, and the consensus was that the requirements of IAS 38 are applicable to cost the entities incurred with regards to the development of website it is concerned. But okay, before we look at the nitty-gritties of the accounting treatment with regards to the cost the entity has incurred in developing website costs. Here's just a snapshot of the development phases that the entity will go through with regards to the development of a website. There's the aspect of planning, whereby it carries feasibility stages. There's also application and infrastructure development. For example, the entity incurs the cost to obtain domain, etc., etc. Then we have got also graphic development, whereby the entity is going to fine-tune how the website is going to appear. And lastly, we have got also the issue of content development. And as I see now, as I have mentioned earlier, that the key issue was whether the cost the entity has incurred, should they be subjected to the requirements of IAS 38 or not. And as I see, the interpretation committee says the requirements of IAS 38 should be applicable, but provided that certain recognition criteria has been met, like if the entity has incurred the cost to develop the website, but no, to the extent of promoting its services, those costs are supposed to be expensed during the period that they have been incurred. But you have got a situation whereby the entity has incurred the development cost, but not for the purpose of promoting its goods or services. Then those costs are supposed to be capitalized to the cost of intangible asset, but subject to the requirements of IAS 38. So you are supposed to go and read SIC 32 so that you be fully conversant of its requirements. And even during exam, if you are not sure, you can easily refer to the standards so that you'll be in position to navigate around as well as provide the solution as required by the standards. Then moving on to the next slide, we are now going to look at the tax implications that arises as a result of intangible asset. Because remember, for each and every transaction that the entity has entered into, there is also the tax implications. So remember, we are going to have the deferred tax asset, etc., as well as the temporary difference. Therefore, now this is also another critical aspect or another critical area whereby we are going to integrate FINAC with other modules. Like in this case, when it comes to tax implications as a result of intangible asset as a result of computer software, this one, it is subject to SIA as per the 4th schedule of Income Tax Act. And under this, we are saying in the first year, the entity has acquired computer software, it is subjected to 25% depreciation as an allowable deduction. Then thereafter, it is subjected to accelerated depreciation at 25%. So for the purpose of you calculating the taxable amount or the taxable value versus the carrying amount that you are going to use for the purpose of calculating deferred tax, is something that you're supposed to pay specific attention. So sometimes the scenario, you might not be told in the scenario, but you must make use of your tax knowledge to your benefit. And even at ITC, the more emphasis is on the integration of all the 4 modules to make sure that you be a complete chartered accountant. Then we have got section 15M, which allows deductions for experiments and research, but provided that those ones are not of capital nature. So I encourage you to just go through those requirements as well as section 15, which allows deductible for copyrights, designs, patents over a period of 10 years. So I think it's something that you can refer to in as far as your Income Tax Act is concerned. So those are the income tax implications that arise. So thank you so much. This marks the end of the part 1 of this video session. So meet you in the next part, which is part 2, where we are going to look at the accounting treatment for inventory. Thank you.